Greetings guys, I welcome you in this wonderful video. So I'm just going to be giving you some tips on how to use price action trading volatility indices. Yeah, so it's all the indices, but I'm using a chart for volatility 75 now, so it's all the indices. So I'm just going to be giving you these important things that you need to consider when using price action. So what you need to understand with this, you need to understand that this asset, it is more of a trending market, so it can move in the same direction for a long period of time. That what I always say when I'm teaching about this. So you can see that it's been moving in an uptrend for quite a while now. So when it moves in a direction, it can spend a lot of time in that particular direction. So that's the first thing you should keep in your mind, that this is a trading asset, it is a trending asset, so it moves in one direction for a while. So the only difference it is that there've been some deeper pullbacks and smaller pullbacks, so that what it makes it look like it's not just a long-term uptrend when you have zoomed in like this, but overall it's been moving in an uptrend for a while. So then when it comes to you trading it or analyzing it, that's the first principle in your mind, that this market can move in the same direction for a while. So let us get into this impulsive wave here. Okay, so here we are in this downward move here. So the other thing that I want you to note, it is the issue of transitions. Now, I've been teaching about transitions in analyzing the markets. I hope some of you guys know about it, whereby the buyers, they hand over the market to the sellers through a dealership or through a pause. For an example, yeah, it can be something like this, although it's a small one. Let me check another example of a transition, a very good one. It can be something like this. Yeah, so it's something like this, guys. Those are transition, and usually when it comes to this market, they don't happen frequently, they don't take place frequently. So that's a very important thing that you need to understand in trading other assets like stocks or currencies or commodities and all those other assets. Remember that we always say without a transition we don't take a trade, but here it's the opposite, guys. Even if there is non-transition, you need to understand that in transition they don't usually take place. So what you have to understand, it is just to see the flow of that wave, and once that flow is disturbed or it's broken, then you are ready to enter. So you can see here it's just an up move and then a down move without any transition, an up move, a down move without any transition, an up move, a down move without any transition. So you don't have to wait for it, but you just need to understand when this upflow here is broken. When this upflow is broken, then you are ready to enter. When you see a big red candle coming in after the green ones, then you are ready to enter. So there should be no question asked. You just look at the break of this upward flow, and then you enter the market at the break of this upward flow, and then you enter the market. So that's how you should go about it. There is no need for you to wait for the dealership to take place. There is no need for you to wait for that. And one other important thing, guys, that I will remind you, it is this issue of when it comes to trending markets. Remember, we have two ways to enter trending markets. Né? We can either enter by maybe support becoming resistance or resistance becoming support, or we can enter by trend lines. Né? We have two ways to enter a trending market. So here you can either draw a trend line here and enter using that trend line, or you can use support becoming resistance or resistance becoming support. And remember that I told you that this is something that happens frequently in this market, where support will change into resistance. And if you are going to use that method, it is going to be very helpful, because that's how this market flows. That's how this market flows. Resistance have a tendency of becoming support, and support has a tendency of becoming resistance. Why? Because it's a nature of a trending market. That's how it moves. So you can see here, resistance from support, resistance from support, resistance from support, resistance from support. So you can enter using that method because it's a trending market. So it's just the simplest way, because when it comes to trend lines, the issue of trend line is that there is market shift, or there is trend shift, where a trend will shift, for an example, from an aggressive trend into a more slower trend or something like this. So when it comes to trend line trading, you need to be also flexible in your trends, be flexible in changing them, be flexible in adjusting them. So that's the bad part about trends. You should be there when there is a new wave, shift your trend. When there is a new wave, shift your trend. So that's how it goes. But in support becoming resistance, it can still work. Same thing applies in this example that I made. So you can see that support, and it has been resistance for 1, 2, and 3. It has been resistance for that long. There is no need for you to shift it, because levels, they're always significant even in the future. So that's it, guys. Thank you for watching. Remember to like, share, and subscribe. Thank you.